Well, the Magnificent Seven have pulled the S&P 500 higher by nearly 25% so far this year, while the rest of the index lags. Our next guest sees the stock market rally continuing into 2024, as long as the other 493 catch up. We want to bring in Brooke May, Evans May Wealth Managing Partner. Brooke, so thanks so much for joining us this morning. Let's talk about this catch-up trade. What's the expectation when you think about the rest of the S&P 500 for 2024?
Yeah, we are very optimistic going into 2024. We think that the S&P could hit 52 to 5,400, and that would be about 11% earnings growth from here. Right now, the S&P looks expensive at about 21 times earnings. But if you factor out those 7 names, the multiple is much more reasonable, around 17, 18 times. So we think that there's some opportunity there. And as we've seen the breadth of the market improve, meaning more names participating, we think that that's going to give the market another leg up.
So, Brooke, in terms of the sectors and the companies that you think have a lot of upside to go, obviously the Magnificent Seven have been taking all the headlines, but that has left a lot of the S&P 500 out of the conversation. Where do you see the upside?
Yeah, right now we still like the big tech names. We think that there's good earnings growth there. So we don't feel like you need to completely rotate out of those positions. However, there are some really good deals out there and values. One of the names we like, for example, is Charles Schwab. Unlike a lot of other companies that are hitting new highs, Schwab's down 17% year to date. They just completed the merger with TD Ameritrade. So there's going to be some cost synergies there. In addition to that, the fact that we've had an inverted yield curve has really hurt their earnings because interest is a big part of what contributes to their profitability. So as we see the yield curve return to a traditional slope, that'll be a little bit of a tailwind for Schwab as well.
And then, Brooke, I want to ask you in terms of just the broader breakout that you're looking for, especially for that target that you're thinking about, S&P 5,200. What's the catalyst to get there for the other 493 names?
Well, we're going to need to see earnings growth. And right now, again, we think we'll see 11% earnings growth from this year to next year. And that's going to be really led by the consumer. As we've seen, the labor market remains very resilient, very strong. And if consumers have job security, they're going to spend. And if they've depleted their savings, they're going to use credit. And we're nowhere near an overextension in credit. So if unemployment stays low, we think that consumers are going to spend, and that's really going to contribute to earnings.
And Brooke, we are seeing more cash coming off the sidelines for 2023. Cash and things like mutual funds were definitely king. At what point, though, do you think we'll start seeing more of that cash coming back into the market? And where do you think it will head as you look at some of the risks that some of the markets might not be pricing in?
Mm-hmm. It's remarkable. There's $6 trillion in cash and money market on the sidelines. Last year alone, $1.4 trillion went into money market funds. And surprisingly, we saw the 10-year Treasury hit 5% back in October. Money didn't flow into bonds like you would have expected it to. People are comfortable sitting in a money market at 5% and didn't necessarily want to lock in corporate bond rates or treasuries for the next 5-10 years in the 5% range. So only 276 billion went into bonds last year. So when there's a little bit of a FOMO catch-up trade going on right now, which is why we've seen the market rally these last 2 months. And we think that's going to continue. People have missed out on this rally and they're going to want to participate. They're going to take their money out of money markets. And if they haven't already moved into bonds, they're probably going to add that money to equities.
Brooke, I want to talk to you about, we're talking about big names, talking about the S&P 500, but let's talk about small caps. What's the play there? Where do you see that small caps, the Russell 2000, participating in the bullish environment that we're seeing into 2024?
Yeah. Wow. The Russell 2000 has rallied since October. Mm-hmm. It's been incredible, and there's a little bit of a trade there just because those names were suppressed and small caps are very cheap. So really, all small caps have participated, or most of them anyway. But from here going forward, we think you have to be selective. You can't necessarily buy small cap as a broad index. If you look at debt, for example, small cap companies, only 40% of them are profitable. So a lot of those companies are working off of debt. And for the S&P 500 companies, only about 6% of the debt is at variable rates. For Russell 2000 companies, around 30% of their debt is at variable rates. So there's still more risk there. So we like small cap. We think that this is a great entry point because they're still relatively cheap compared to historical averages. But you need to be selective and buy companies that have proven to be able to navigate this higher interest rate environment.
Investors going to have to do their homework there. Appreciate you joining us this morning. Brooke May, Evans May Wealth Managing Partner. Thank you for joining us.
Thank you.